Hello and welcome. You're tuned into MF Corner. I'm Sonal Bhutra in the Mumbai studio. And at a time when the market is experiencing wild swings on the back of geopolitical tensions in the West Asia and other things happening as well, should you find refuge in commodities or should you invest in commodities? If yes, how do investors go about it? Especially from the mutual fund route, we've been talking about that one-way move on gold. Silver has been higher as well. A lot is happening in that space. So this is what we are going to be discussing with our guest today. Chirag Mehta, CIO at Quantum AMC, and Kshitiz Mahajan, co-founder, Complete Circle Consultants, are on the show with us. Gentlemen, good afternoon. Thank you so much for joining in. And while we keep talking about equity funds and debt funds, one category that has done impressively well is the gold segment, right? And the silver as a metal also has done really well. Chirag, let me start with you. So while we're talking about a lot about gold and silver, just want to understand, is this the way to take exposures to commodities via mutual funds? What are commodity funds? And for Quantum specifically, what are the kind of commodity funds that you have launched?
So yes, commodities have been, different segments are available in commodities. But if you see, largely, most of the commodities are industrial commodities, as opposed to something like gold and silver, which have in history been part as a monetary asset and hence are somewhat different as compared to most other traditional commodities. And silver to an extent also lies somewhere in between gold and other commodities, given that today 65% of the usage also comes from industrial uses. So commodities per se, most funds in India have launched a gold fund, a silver fund, or a fund of funds based on gold and silver. But apart from that, we haven't seen a pure commodity fund as yet in India. There are some funds that in the multi-asset space have exposure to commodities to some extent, but those are largely arbitrage positions as opposed to being outright commodity exposures. Overall, there is a big difference between having a commodity exposure. For example, gold and silver usually will tend to have physical underlying exposure to those metals. Whereas if you see most other commodities, given the bulkiness and storage issues, tend to be more driven by exposure through derivatives. And given in that derivative space, sometimes, there's something called a roll return, whereas you have to roll from one contract to the other. And usually you end up losing some return because of that rolling that takes place. You are buying a contract which is a higher price and selling one which is at a lower price. And hence there is a roll return that gets deducted from the overall return you end up making.
Okay.
So commodities per se are mean reverting, and given that they give exposure to economic cycles, the same exposure you get through your equity exposure, and hence you should see what kind of exposure you end up having if you have some commodities in your portfolio. But gold to that extent is very, very different. Gold does well when usually economies are not doing well, and hence it gives you a very different exposure as compared to other commodities. So from a portfolio standpoint, I think gold deserves a dedicated allocation in one's portfolio as compared to other commodities.
Makes sense. Actually, you just preempted my next question as well, and you spoke about mean reversion. So in that case, just to follow up on this before I go to Kshitij as well, who should go ahead and invest in commodity funds? Is it only for risk-savvy investors? And how can one look at this segment from the fundamental lens?
So when it comes to commodities, of course, a professional will help you better as compared to you doing it on your own. Having said that, because commodities are usually leverage plays, you need to understand the demand-supply dynamics. And what I believe is the utility of a commodity only stays to the extent it is viable from a price perspective. So if the price really keeps moving higher, there will be substitution that will happen. There will be supply coming on stream, and that will lead to commodities going back towards the mean. That's why we call it mean reverting. Whereas it's a very different case with gold, given that, gold really moves based on various other factors like money supply, because it's been a monetary asset. Today, even central banks own gold. So from that perspective, gold is very, very different as compared to other commodities. In a usual commodity, industrial commodity, you need to be very, very careful because the demand-supply dynamics usually moves the prices, whereas gold moves on various other things. So you need to have an exposure. In other commodities, I'll say if you're nuanced and you understand that space very well, then only have some exposure. But gold is universal; it's for everyone.
All right, that makes sense, Chirag. Let's get in Kshitij in the conversation as well. Kshitij, while we mostly talk about equities with each other, I want your view on gold generally and how to invest in gold, ETFs, gold funds, and we have physical gold as well. But as Chirag was mentioning, physical gold does come with its own cons as well.
Well, hi Sonal. I think very, very well said by Chirag and said the things, put the things in the right perspective. What we are looking at when it comes to investing into gold, and I totally agree that we should have exclusive allocation towards gold, and it's a perfect hedge. Although last 5 years have been a different story all in all, because central banks are buying gold, and that's why you're seeing price moving up. And last 5 years around 15% commodity, which is like equity return in gold. But yeah, there are various avenues through which you can allocate, and I always say that. Best way is, it used to be SGB, sovereign gold bond fund, which I don't think will come further. But then you have ETFs, you have index fund, which is fund of all these ETFs. Then you have physical, then you have digital gold. But if you ask me, the best way is a digital gold, or let's say a ETF, because you have taxation which is very efficient. Any ETF, gold ETF, you can buy from any of the fund. You have a taxation of a long-term off, because it's a listed thing, listed on exchange. You have 12.5% capital gain as like that of equity after a year. If you buy index fund of gold, a fund of ETF, then you have a fixed income taxation with taxation benefit. Normally, fixed income doesn't have any benefit now, but then in gold fund of fund, you have 2-year plus as long-term capital gain with 12.5% tax, and less than 2 years is as per your tax slab. So I think this is one thing where you don't have to worry about the purity of gold. You don't have to worry about where you have to keep that gold. And then the taxation is also in your benefit. And then you can accumulate over a period of time. Either you can do a lump sum, or you can actually do a SIP also in any of these gold funds, which can help you to accumulate the amount which you want to buy, let's say, for your kids' marriage, or as a hedge of the portfolio also. And anytime you can redeem this money and buy the gold at the market price, because price moves in tandem with market price of gold. I think 5 to 7% minimum is something which I think one should invest in gold. Although there are ways and means where you can look at multi-asset fund through which you can take exposure also in gold. And these funds. Many of these funds are coming with equity taxation, where they have a combination of equity and arbitrage, where you have a taxation benefit also. But then the percentage is around 10%, and you don't have only multi-asset fund in the portfolio. The overall portfolio allocation should be around 5-7%.
All right, take that point. So there should be some gold in your portfolio for sure at any point in time. We take that point. Chirag, coming to you. So you spoke about, of course, only if a person is very well versed or a pro in markets, they can just go ahead and invest in such a fund. But what are some of the risks they should keep in mind, even if a novice investor is going ahead and investing via their advisors as well? How does it differ in terms of risks versus, say, equity funds?
So when it comes to a gold fund, the only risk is it moves along with the price, as Kshitiz explained. If the price goes up, it goes up. And if price goes down, gold price goes down, then it goes down along with it. It tracks gold prices very, very constantly. So in a gold ETF, I don't see any risk per se, except the price risk that comes along with the underlying. Because if you see from a gold ETF perspective, they are backed by physical 24-karat gold. They are stored in secured vaults. They are completely insured. They are very, very liquid instruments. So from all perspective, I think the regulations have ensured that they are supposed to do what they should be doing, what they are mandated to do. But when it comes to a commodity ETF, of course, there are various risks that come along with it. One is you get like for example, in an equity fund, you tend to have in terms of wrong stock selection that comes, or wrong allocation that comes. But in a commodity fund, the downsides can be really, really large if you have not got it right, because commodities tend to move very fast and they are very, very volatile. I'm talking about the industrial commodity space. And hence you need to be very, very nuanced when you're looking at building a portfolio of commodities. So it should be very well diversified portfolio of commodities. A single kind of commodity exposure can be very, very volatile and, come with huge downside risk. So from that perspective, I think average investors should stay away from other commodities. As I said, they tend to be mean reverting. So there has to be diversification and rotation that should be built along that commodity exposure. Otherwise, it could be really a risky proposition for your portfolio. So I think when it comes to an average investor, I think they would be very well poised with gold. People tend to, replace it with silver to some extent, saying it's cheaper cousin of gold and available at a cheaper price. But if you look at the volatility in silver, it is also significantly large as compared to that of gold. And when it comes to silver exposure also, it tends to move alongside your equity exposure at times, because when there is a risk aversion, it tends to fall along with your equities, whereas gold is on the other trajectory, it's moving up. So from that standpoint, I think investors would be very well placed when it comes to gold. And when it comes to risk, I don't see, if you have crafted the position well, like Kshitiz was explaining, he said 5 to 7%, but we tend to think 10 to 15%, because at those levels, you are minimizing your risk, at the same time not impacting your overall portfolio returns, and hence 10 to 15% is the right crafted allocation that we have come through numbers in terms of, as opposed to by a gut feel in terms of what allocation one should have of the portfolio.
Okay, so, there are more questions on this, and the most important question is it still the time to look at these funds? But we'll get this on the other side of this short break, and we'll continue our discussion on how to invest into gold and silver as a commodity via mutual funds. Stay tuned. Welcome back. You're still tuned into MF Corner. We still have with us Chirag Mehta and Kshitiz Mahajan. We are talking about taking exposure to commodities via mutual funds. And later on the show, we'll also discuss a little bit more about the mutual fund industry. Chirag, let me come to you. I asked this question to Kshitiz. Just wanted your take. If one has to take exposure to gold or silver, should it be via funds, ETFs, or multi-asset funds? And after the sharp rally, do you advise investors to look at gold or silver as an investment option?
Investment choices, I think gold ETFs and gold fund of funds are similar exposure for anyone. So if you're looking for exposure to gold, they are the best available options today. Why I say that? Because they are very, very price efficient. Usually in a physical market, if you go, the lower the denomination you buy, higher the premium you have to pay. In a gold ETF or a gold fund of funds, you're buying 0.01 grams of gold or 500 rupees worth of gold in the gold fund of funds. You are not paying any premiums. You're paying prices close to wholesale prices. And these are international gold prices you end up paying when it comes to gold ETFs or gold fund of funds. You don't have to worry about the purity of the gold, the physical custody of the gold, the safekeeping of the gold. It's stored in secured vaults and completely insured. It's liquid. You can buy, exit at any point in time. Like for SGBs, you had to wait for a tranche to come in to be able to buy it. Here you don't have. They're available virtually 24/7, and you can exit virtually 24/7. So it's very, very liquid instruments, and they have liquidity for last 14 years of trading that they have had. So they are extremely liquid instruments, and they're very, very convenient. It comes along with your mutual fund statement, or it comes along with your DMAT statement. So you can, club in along with and have a portfolio view in terms of what your allocations are. So these tend to be very, very efficient choices today that are available in the market, much superior as compared to the physical choices that you have. And there were like SGBs, but they are not available anymore. No fresh issuances are happening. Plus, they were not backed by physical gold. So client preferences or investor preferences tend to be towards physical backing of such products. Hence, these are the best choices available today.
And your take on the current levels for gold and silver, if you can quickly tell that to us.
So if you see last year, it was a year of headwinds for gold and still it ended up doing well given the geopolitical concerns that were prevailing. Now we are at the change of interest rate cycle. And as interest rates go down and probably inflation may not go down as aggressively from here on, the real interest rate tends to be the big driver of gold. And I think that should be a supportive factor for gold from here on as we see more interest rate cuts. And if there is any meaningful slowdown in the Western world, then probably it should add more flavor to gold. Also, we have seen diversification of reserves and investments into gold, reserves from central banks and investments from private investors. And we believe that is set to continue. Another encouraging trend is the de-dollarization move that we are seeing, which is slow, but it's sort of a lasting theme. And we think it's here to stay. Given the weakness in the dollar, which should accompany the rate cuts, gold should get supported further. So all in all, we are seeing a more constructive, fundamentally constructive view of gold. So if there is any downside that could occur because the interest rate expectations can, sometimes be priced more aggressively than what it tends to be. And hence, it may give you some opportunity in the short term, but that should be bought into for that long-term view that we have for gold.
All right, take that point, Chirag, and thank you so much for joining in today with your thoughts on how to go about investing into gold or silver from the mutual fund angle. It was a pleasure speaking with you. Okay, let's continue our discussion. Kshitij, we have a lot to ask you, but I think we don't have much time. But I have to ask you, we've been talking about bank deposits moving to mutual funds. So is this largely money moving, or is it new investors coming in and contributing to mutual fund flows? Because bank deposit number is also growing. So if you can quickly tell us, my director tells me we have just 2 minutes.
So, bank deposit flows are coming, but at the same time, you have 35, 36 lakh of new SIP accounts getting added every month, which is a very positive sign. And, we are almost about to get 3 billion of SIP inflow, which in itself makes us, a very, very retail specific market. And I think this number is not going to stop here because there's a right way while clients are approaching their SIPs, and that's the broader market. And many of people are guiding them rightly that you have to link your SIPs as per the gold plan also. So people are not just closing their SIP depending on any market correction. In fact, I've been seeing that many people at lower end of the segment also, they are getting into SIP. Now we have 99 rupees SIP also available, and then you have 250 rupees SIP available. So I think that regulator push also is there that people should get into an organized way of investing rather than just getting into some Ponzi schemes and then losing their money. I think a lot more people will come. And so we keep on talking about there's a lot more number of people who are coming to this fold, but only 4.5 crore unique mutual fund folios are there. So and 10 crore unique Demat accounts are there. So it's a long way to go. We have 55 crore PAN card linked to Aadhaar. So we have a big market which can come to this foray and this side of the stream. So yes, numbers, we are waiting numbers from MP, how things have shaped up. But I'm sure September is again going to be a better month only. And let's wait and watch. But I'm saying the message is very loud and clear that people should get into an organized way of investing. They should look at, they just don't do SIP because for the sake of it, but they should look at how they can build a long-term wealth with a disciplined approach.
Right. That makes total sense. And of course, all of us are awaiting the September data. It's expected today. Anytime now, we'll have those numbers on the screen, and we'll get you back again for your analysis and reaction as well. Always a pleasure speaking with you, Kshitij. Thank you so much for joining us today.
Thank you. Pleasure.
All right. That's all we have on the show today. Stay tuned for Closing Bell to take you through the last hour of trade.